Hey everyone, welcome back to Corporate Decoder. Today, CXApp Incorporated's latest quarterly report just dropped, and I'm seeing some fascinating shifts after their recent acquisition. Quick note, this is not financial advice, just my take on public filings for educational purposes. This filing shows us how a recent acquisition is changing their business and their financials. So let's dive in. Okay, first off, this report is for the quarter ending the 30th of June 2026. We are looking at CXApp Incorporated, a company that provides what they call intelligent enterprise workplace experiences using AI. Think of it as a tech platform to make modern offices work better, especially with people working from home sometimes and in the office sometimes. Let's start with what the company owns and owes. On the balance sheet, as of the 30th of June 2026, CXApp had about $11.7 million in cash. That is up a bit from about $11.1 million at the end of 2025. They also have a good chunk of what they call intangible assets, nearly $15 million, and goodwill worth over $7.6 million. These usually come from buying other companies. Total assets for the company are about $36.5 million. Looking at what they owe, total liabilities are just over $18.4 million. So it looks like they owe a bit less than half of what they have in total. Now, for the really interesting part for investors, we need to look at their income statement. For the 3 months ending the 30th of June 2026, CX reported revenues of about $1.7 million. That is up from $1.2 million in the same period last year. This increase seems to be driven by their recent acquisition of a company called Engine Room. However, their cost of revenues also jumped significantly from $171,000 to $623,000. This made their gross profit barely change, staying around $1.05 million for both periods. This is a big change in how much money they keep after paying for the direct costs of their services. Operating expenses, which include research and development, sales, and general administrative costs, were around $5.19 million for the 3 months ending the 30th of June 2026. This is almost the same as the $5.16 million in the same period last year. They've managed to keep operating expenses steady even with the acquisition, which is a good sign of cost control. But, and this is a big but, their other income and expenses line took a massive hit. Last year, they had over $900,000 in income from this category, but this year it is an expense of over $5.1 million. This huge swing is mainly due to changes in the value of derivative liabilities and warrants. This is a complex accounting item, but essentially, it means the value of these financial instruments went down significantly, costing them a lot on paper. All of this resulted in a net loss of about $8.6 million for the quarter ending the 30th of June 2026. This is a big jump from a loss of about $3.1 million in the same quarter last year. It is clear that while revenues are growing, the increased costs and accounting adjustments are hitting their bottom line hard. Looking at the 6 months ending the 30th of June 2026, the story is similar. Revenues are up to $2.6 million from $2.4 million in the prior year. But again, the cost of revenues increased much faster, leading to a lower gross profit compared to last year. Their net loss for the first 6 months of 2026 widened to about $12.6 million, compared to about $4.7 million last year. The acquisition of Engine Room is definitely impacting their financial statements, bringing in new revenue, but also new costs and accounting complexities. Now let's look at what is happening with their stock. As of the 30th of June 2026, they had over 109 million shares of Class A common stock issued and outstanding. This is a huge jump from about 33.7 million shares at the end of 2025. This massive increase in shares is likely due to conversions of debt and stock issuances related to their financing activities. This is a significant dilution for existing shareholders. The additional paid-in capital also shot up from about $104 million to over $121 million, showing the money raised from issuing new shares. However, their accumulated deficit, which is basically their total losses over time, also grew from about $90 million to over $103 million. Looking back at the 30th of June 2025, they had about 21.4 million shares outstanding. So in just 1 year, the number of shares has exploded. Let's see how they are managing their cash. For the 6 months ending the 30th of June 2026, they used about $4.4 million in cash for their operations. This is similar to the nearly $4 million used in the same period last year. Despite revenue growth, their operations are still burning cash. Investing activities used about $3.2 million this period, mostly related to acquiring Engine Room. Last year, it was a very small amount, just $16,000. On the financing side, they brought in about $8.3 million in cash. This is a big increase from the nearly $4 million they brought in last year. This cash came from issuing more convertible debt and from their at-the-market stock offerings. Overall, their cash balance increased by about $574,000 for the first 6 months of 2026, ending with $11.7 million. But remember, this increase is mainly from borrowing and selling more stock, not from profitable operations. Now, let's look at the important notes to understand the numbers better. Under the liquidity section, they admit that they have had recurring losses and negative cash flows from operations. This raises what they call substantial doubt about their ability to continue as a going concern. This is a very serious statement. They believe their plans, which include managing costs and getting more funding, will be enough to keep them going for at least a year. But they also mention that some of their financing depends on market conditions like their stock price, which is concerning. They also have a lot of convertible debt, which is money they borrowed that can be turned into stock. They've been issuing more of this, like with Avondale Capital LLC and Streeterville Capital LLC. These agreements allow them to get cash now, but it means they might have to issue a lot more stock later, which dilutes existing shareholders. Under accounting policies, they mention that the fair value of their warrants and convertible debt is measured using unobservable inputs. This means they have to make educated guesses to figure out these values, and actual outcomes could be quite different. This is often a sign of complex financial instruments that can be risky. Looking at how they break down their revenue, subscription revenue is still their largest piece, making up about 92% of their revenue for the quarter. However, after the Engine Room acquisition, they've added managed advertising and growth marketing advisory services, which are a new source of non-subscription revenue. This shift in revenue mix, as they mentioned, is a big reason why their gross profit margin has decreased. Most of their revenue, about $1.68 million for the quarter, is recognized over time. This means customers get value from their service as it is being delivered, like with their software subscriptions. Only a small portion, $12,000, is recognized at a point in time, which likely relates to hardware sales. This section details the acquisition of Engine Room. They bought it on the 3rd of June, 2026, to expand their services into managed advertising and marketing. They've made a preliminary allocation of the purchase price, but it is still being finalized. They've recorded about $1.1 million in goodwill from this deal. Goodwill represents the premium they paid over the fair value of the acquired company's net assets, often reflecting intangible things like brand reputation or expected synergies. Moving to the other information, there are no major legal proceedings or risk factors that have changed since their last annual report. And importantly, there is a note about insider trading arrangements and policies. It states that no directors or officers have adopted new trading plans under Rule 10b-5-1. This is generally a positive sign, meaning there haven't been any pre-planned stock sales by insiders that could signal a lack of confidence. Finally, the exhibits list all the agreements and documents related to this filing. One notable exhibit is the share sale deed for the Engine Room acquisition. So, what is the story here? CXAIW Incorporated is growing its revenue largely thanks to the Engine Room acquisition, but this growth is coming at a cost. Their margins have squeezed significantly and their net losses have widened. The massive increase in outstanding shares due to debt conversions and stock sales is a major concern for dilution. While they have managed to bring in more cash through financing, it is not from strong operational performance. The company is essentially betting on its AI platform and the acquired marketing services to drive future profitability. But the current financial picture shows they are burning cash and facing significant accounting complexities with their financial instruments. The fact that they've had to issue so many new shares and the ongoing losses put them in a challenging financial position. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.